What's going on? Welcome back. Ryan here. In this video, we're talking about what are options. Now, I have a couple slides here I put together, and I think that this is the most important thing: is understanding the definitions of what options are, because everything you need to know in terms of the risk is in that definition. Okay, so what are options? Well, option contracts between buyers and sellers are agreements for rights and obligations. Okay, let's read this again. Options are contracts between buyers and sellers. These contracts are agreements for rights and obligations. Option contract buyers have the right, but not the obligation, to purchase or sell the underlying asset for a certain price before the expiration date. Option contract sellers are obligated to purchase or sell the underlying asset at a certain price before or at the time of options expiration. This is like the thing that, if I could tell you anything that you need to remember, this is it. Okay, and that is, there are buyers and sellers of options. These are contractual agreements that are backed by the full authority and power of the United States government. And these contracts are agreements for rights and obligation. Again, let's read through this one more time. Options are contracts between buyers and sellers. These contracts are agreements for rights and obligations. Option contract buyers have the right, but not the obligation, to purchase or sell the underlying asset for a certain price before the expiration date, right? So when you buy an option, you have the right but not the obligation. This is why when you're buying options, it's limited risk, right? Because you have the right to do something, but you're not obligated. On the other side of that, option contract sellers are obligated to purchase or sell the underlying asset at a certain price before or at the time of options expiration. So when you sell an option, you're obligated to buy or sell that underlying security no matter what happens. This is where unlimited risk comes from, right? If we're going to get into this as we progress through these definitions and we start to combine everything, but very important to know the definitions of these option contracts in this classical sense, that these agreements are for rights and obligations, and that whether you're buying or selling, you either have rights or you're obligating yourself to do something. Okay, so the buyers of contracts are known as holders, right? So when you buy an option, you become the holder of that option contract. And the sellers, when you sell an option contract, you're known as the writer, right? You become the writer of that option contract. If you buy an options contract, you could say that you're long the options contract, right? If you sell an options contract, you could say that you're short the options contract. Okay, so moving on here. So remember, option contracts are known as derivative instruments, right? So their prices are derived from the price of the underlying asset, right? So if you're trading gold futures, right? If you're trading that spot price of gold, and the contract that you're trading the options against is the gold futures contract, well, the option price is going to be derived directly from the price of the gold futures. So I just want to say this again because it's so important, because I know that people can confuse this. Until you really study and memorize these definitions and see it in practice, I'm going to keep beating this into you, right? That option contracts are agreements between buyers and sellers, right? And these agreements, these contracts are for rights and obligations, and they're backed by the government, right? Which means that if you don't do what you say you're going to do, the government and the IRS and the governing bodies, the SEC, all these different oversight people, all of the oversight of this whole industry, they can come after you. Okay, so it's really important when you're getting into this business, when you're buying and selling securities, or you're starting to get into derivative trading, that you really have a good idea of what you're doing, because obviously you don't want to lose money. You don't want to lose money that you don't have, and you don't want to get in trouble if you don't do what you say you're going to do. So again, we're going to go over this one more time, right? Options are contracts between buyers and sellers. These contracts are agreements for rights and obligations. Option contract buyers have the right, but not the obligation, to purchase or sell the underlying asset for a certain price before the expiration date, or on the expiration date, which we're going to see exactly what that means. So option contract sellers are obligated to purchase or sell the underlying asset at a certain price before or at the time of options expiration. Okay? The buyers of option contracts are known as holders, while the sellers of option contracts are known as writers. If you buy an option contract, you could say that you're long the option contract. If you sell an options contract, you could say that you're short the options contract. Option contracts are also known as derivative instruments, as their prices are derived from the price of the underlying asset. If you're trading gold futures, again, for example, the options prices will be derived from the price of the gold futures. If you have any questions, feel free to comment or reach out to me. I know people can get confused with these definitions, whether you're already trading or you already know these, or if this is the first time you've heard this. Again, I can't stress enough how important it is to, understand these option definitions. It really is the base for a solid, knowledge foundation of trading. When you start to trade these instruments, is really understanding, the rights versus the obligation in these contracts. Okay, so really important. Please reach out, ask questions. I can't stress this enough, just how important it is to understand these definitions. Okay, so I look forward to seeing you in the next video.